But right away, when you look on the left-hand side, this chart here is the dollar CAD daily chart, and on the right-hand side, it's the hourly chart of the same pair, dollar CAD. Notice that we saw last week, the market traded up, just bumped the short-term high here with that daily high. What do we see once that occurred? What formed on that daily chart? When the market ran into that old high here, it hit it, and the next day it created a lower high candle. So we have one candle, a higher candle high here on candle 2 and candle 3, or day 3. So this is what I dub a swing high. So this swing high at an old high, did it run it? Not by much, but it did. That movement right here is shown clearly on the hourly chart, and the following day, creating a high that has a lower high than the highest one that ran into that old high. So we have a 3-bar pattern. One candle, the lower candle to the left, a lower candle to the right. That's a swing high. Pretty simple stuff. Then the next day, I'm going to be expecting the market to trade lower. Now here's the problem with this particular market. Yes, it's likely to trade down, and with the benefit of hindsight, I'm showing you here. But again, I tweeted about this beforehand. So at 8:29 a.m. Eastern Standard Time, you can see that is on my Twitter feed. If it's dropping down, we have this down close candle here. So it could be met with some resistance digging into this range of this down close candle. About half of its body right in here. And not surprisingly, you can see that's pretty much where we closed that candle here on the 21st of June, 2022. So when we look at this dashed line here, what I'm anchoring to is the opening on this down close candle, because that is a bullish order block. Now, I'm not suggesting that we went into that to go higher. I'm just saying that as we started this down move, it's digging into this candle. So that's going to be the impediment to a big, sudden one big candle that would take us down into this area here and clear out this. So over to the hourly chart, you can see last week we ran up into it, started drifting lower, fair value gap here, it rebalances to that, drops back down, consolidates between this high and the low here, comes back in, drops once more, attacking the sell stops here, consolidates once more, breaks, digs into that order block. Again, that's this level here. So watch what happens. It goes into it overnight, then it rallies. This rally here is ahead of the 8:30 news driver on the economic calendar. You can find it on forexfactory.com. But this movement here, this is all manipulation. That takes us up into an imbalance here, a fair value gap, running a short-term high. Buy side has been taken when it runs here. That's anchored above this short-term high. The chart on the left here is a 15-minute time frame for a dollar CAD, and the chart on the right is a 5-minute chart. On the economic calendar, you can see at 8:30 in the morning, June 21st, 2022, we had a high impact news driver for core retail sales and medium impact retail sales number. Yellow events, I'm not interested in. Red or medium impact, high or medium impact. Those are the news drivers I'm looking for. So if we look at the price movement on the 5-minute chart, you can see that once we ran up initially at 7 o'clock in the morning. What is 7 o'clock in the morning, New York time? That's the beginning of my ICT New York kill zone. It's extended to 10 o'clock in the morning when it's Forex. So 7 o'clock to 10 in the morning, New York local time. The market creates a short-term high, then runs above that. So we have buy side taken, then the market drops just below here, but I want to have a more meaningful displacement. Okay, we want to see something that's more energetic. This little toe in the water type thing here, that's not enough. We want to see it fall in. Okay, so it drops down, that short-term low here, that's your shift in market structure. Energetic displacement, and that candle is exactly when that news driver came out at 8:30. So all of this is news driver related, economic calendar, manipulation, and the market is going to cause people to want to sell short and chase it going lower. It creates a fair value gap in here on the 5-minute chart, but there also is a fair value gap here. Now, ahead of the news, you might be thinking, well, couldn't you have sold short here? Yes, you could have, but the economic drivers that come out at 8:30 could have sent it up higher and taken us into this area here. So really, it's a matter of waiting for the news to hit the market and then create the setup. That's a little bit more conservative. There are times when it's so obvious that they're going to continue the move that starts ahead of the new driver. but it takes a little bit more experience to find those setups and trust them. I would rather you use your demo account to see these types of moves real time, wait for them to form, and then go in and engage them with your demo. Not try to forecast how much of a move it's going to further increase higher or lower once the news driver comes out or the news event hits the marketplace. Relative equal lows down here, there's your sell side. So we had this fair value gap formed after buy side was taken here, but now this creates an area of buy side. That once this trades lower, we have this fair value gap and then we have this fair value gap. So it could run up into that level with the volatility. So you're going to have to make sure that you have that defined with your risk management. The draw on liquidity is likely to pull down into here or into this fair value gap. And we'll talk a little bit more about why that's the case. But eventually it trades down into it, bagged and tagged, sell side liquidity. Now drop down into a 4-minute chart, and I dimmed the fair value gap that I mentioned earlier, that you could have taken that trade, but it'd be ahead of the news driver, and it's a little bit more riskier. But you wait for the displacement, short-term low is taken, then we have a shift in market structure, and the imbalance would be between this low of this candle and the high of this candle in here. Now by itself, this is a rather elongated imbalance. So all of this sell side delivery is imbalanced, and there's not enough buy side delivery. So it's going to want to wait for the market to come back up in here. In Forex, there is no central measure of volume. Okay, and in the algorithm that delivers price, that is going to want to come back up and overlap this down move and offer buyers an opportunity to get in on that. This is too much of a movement one-sided, so the market offers that rebalancing. So if that's the case, where in this range would we be looking for an entry? Knowing that this fair value gap could be revisited, and you're going to have to utilize that for your stop loss. So your stop would have to be here. So if we look at that range from that high down to that low and drop a fib on it, we're going to get a measurement of 50% here. That's our equilibrium price point. So really, we need price to get to that point or higher. So by definition, we could be looking for a short here up to here. And that would look like that. So that's really the range that you'd be wanting to sell short in. So you're not really risking a lot of pips, but you're defining the entry a little bit better. Even though it goes above it a little bit, that's okay. But the bottom line is that it eventually gets in sync. Watch the bodies of the candle support that premium high of the imbalance. Beautiful delivery. Then it starts to break lower. One more time, false little rally. Takes buy side liquidity once more. Then the real move starts to unfold. Trades into the fair value gap here. Take partials. So that way, if this reverses on you, you're paid. And it drops below a low where engineered sell side liquidity would be, and then digs into the sell side liquidity over here. All right, so I have a 4-minute chart here with all the details shown. Sell side liquidity pool, relative equal lows from the morning. It rallies up, creates a high after running buy side liquidity. It breaks down, consolidates, it gives a short-term swing low here with an energetic run lower at the high impact news event at 8:30. Rebalance, stop goes here, and it rolls over during the 10 o'clock to 11 o'clock. That time frame, 10 to 11, that's London close. So if you're looking for directional plays and you're in a trade, you want to have about 80% of your trade off between 10 o'clock and 11 o'clock in the morning. Because usually, not all the time, but usually that's when it creates the opposing end of the daily range. So if it's creating the high of the session here, the low is likely to form between 10 o'clock and 11 o'clock. That's algorithmic. Now there's sometimes, if there's news events, sometimes Canadian dollars influenced by crude oil numbers, and that would sometimes skew this time window, 10 to 11. So on those days when there's crude oil inventory numbers coming out and I'm interested in trading the loonie, I will trade with the expectation between 10 o'clock to noon and not have such a tight little window of 10 to 11. And I promise you, I have students for days and days and days and years now that will confirm that this has not just been form fitted for this example. I've always taught that 10 o'clock to 11 o'clock in the morning is London close profit taking hour. I'm quite sure if you go through the older teachings I have in this YouTube channel, you'll probably actually hear me talk about that very thing as well. This is the simplification that I make for daily bias. If you stick to these rules, you will know how to find daily bias as I teach it. My students follow these rules. Okay. I'm going to go through them with you. And you're going to be kicking and screaming and saying, no, there's something else you're holding back. There isn't. It's experience. It's doing it yourself. But the keys to daily bias are simply this. Everyday bias is unrealistic. If I go in looking for a specific predetermined daily bias before the market starts trading, invariably, I'm going to have it incorrect. Notice I said that I'm not perfect. Some of you hold me up to this hero level status, and I'm not a hero. Okay, I'm just somebody that knows what they're looking for and knows how to avoid, hopefully, making the same mistakes over and over again, because I'm looking for a procedure and process that will lead to an outcome that generally, not all the time, but generally yields a specific result. So I'm not trying to get a daily bias every single day. I'm trying to determine the likely weekly expansion. And again, what is that? I utilize a weekly chart and I study that, and I want to see, does it look like it's going to run to an old low? Does it look like it's going to run to an old high? Or is it running to a imbalance below the market price? Or is it trying to run to an imbalance above the market price? Or is it likely not to move because there's no data for it for that week? And other markets have high impact or medium impact news that would be more interesting, and the algorithm will be working those pairs or markets. And the pairs or markets that don't have a high impact or medium impact driver will probably be a lackluster market environment. I'm looking for the direction of an expansion move. I'm not trying to get the entire weekly range. I'm not trying to buy the weekly low and sell the weekly high. I can, but that's not what I'm trying to do. You don't need to do that, okay? I know some of you hate when I do that, but I'm trying to make sure that you understand there's a distinction between what you should be coming into this with in terms of expectations and what is realistic, okay? In the beginning, all you're trying to do is determine, is it likely to expand higher? Is there going to be a big move, a flurry of activity going higher during the week or going lower during the week? And by itself, that is huge in terms of what you're trying to pick. Now, you might be wrong, because sometimes I get it wrong. But I'm looking for some volatility in a direction based on what I'm studying on a weekly chart. So this is a daily chart shown on this slide here. The same thing I would be doing to determine where the daily chart's going, I'm trying to do that with a weekly chart. But I'm only interested in seeing what's it likely to reach for. I'm not trying to predict the weekly closing price on that candlestick. I'm trying to look for where is the bulk of that volatility going to be pushing, higher or lower, and why would it be like that? And it's as simple as what I mentioned earlier. Is it aiming for and gravitating towards an old high to run above it? Or is it gravitating towards an old low to run below it? Or is there an imbalance where it needs to come back and revisit that? Because it might just drop down to a fair value gap to go higher longer term. I don't even need to know that. All I need to know is what direction is it most likely to have the majority of the volume pushing through. Now, when I say volume, there is no centralized volume number in Forex. When I say the volume, that means the interest, the chaos, the energy, all the activity, the action, okay? Is it going to be on the higher side, reaching for buy side, or is it going to be on the lower side, reaching for sell side? That's what I'm looking for. I want to find where is it likely to gun for this particular week. Who's in the crosshairs? Have people been making money going long? Is there a low that they're going to try to run down and stop them out with it? That would be enough for me to frame an expansion going lower. So I'm looking for obvious liquidity in that direction. Below old lows, above old highs, or identifying imbalances in price delivery top down. That means from the weekly down to the daily, down to the 4 hour, down to the 1 hour, to the 15-minute chart. And then once we get to the 5-minute chart, you do the scalings from 5, 4, 3, 2, and 1, whichever has the clear, obvious fair value gap for you based on the model's rules. And I focus on days that have high or medium impact calendar events only. So if you go through your economic calendar, in fact, you can look at next month's economic calendar. They're already there. Where are the high impact or medium impact news events for the markets that you trade? What day of the week and what time? So if you have a news driver that's coming out on a particular day, say Tuesday or Wednesday, and you're expecting the weekly range to expand lower, well, on those medium impact or high impact news events, I'm going to see, hopefully, something that is going to run up higher, go into a fair value gap, or run above a short-term high, run stop, then break down, show displacement, then create a fair value gap, and I can go in short on that. And I'm doing that and looking for that setup and that directional price run inside my kill zones intraday. At the same time, the economic calendar is suggesting a high impact or medium impact news event is likely. So what did I just teach you here? I basically said that there is absolutely no expectation on my part to know the bias every single day of every single calendar trading day. I'm only focusing on these sweet spots, these low-hanging fruit days where everything's coming together, all the stars are lining. Okay, I'm looking for the higher time frame weekly to expand in a specific direction. That starts my bias. And then, if I think it's going to be going higher or going lower for a specific target or imbalance, then I'm going to go to the economic calendar to look for when that might occur. Now, there may be a move that happens prior to the economic calendar event occurring, and that's just going to be a missed opportunity. So you have to use something else, some other pair, something else that you got to trade with. Sometimes that occurs. But you'll see that there's a lot of opportunities using this criteria. And it's very forgiving for you as a developing student because it's already given you permission not to know the daily bias outside of these rules. All right, so we're looking at the hourly chart here on the S&P. Obviously, we've traded down. We left relative equal lows, but this low went just a little bit lower than that one. That's all we need. It hit that and it started retracing higher. This movement here, that's whipsawing both sides of the marketplace. Sell side taken, then buy side taken, and then it broke down. Whenever I see price action like this, I ignore the both side type movement. Usually that's FOMC or some kind of rate announcement type event, and that's what you're seeing here. When I see that, I ignore that wick, and I ignore all these as well. The real range is here. This is manipulation. It's already done. It's not going to hurt you. Focus on this swing here. So when the market drops down, it creates this low, runs a little bit lower. We're consolidating. We had a holiday on Monday. The market starts to drift higher. And what I'm concerning with this run here is this high to that low. And I'm getting my range. Equilibrium is here. So if it's going higher, what's it reaching for? Well, it's going to go into a premium. And this right here, this imbalance, I'm not really interested in that one because it's overlapping with that equilibrium 50% level of the high to that low. So I want to see it dig into a premium. So even if this is going to go up to go down, I want to know, do I have an opportunity to see it go up into this area here or maybe even up here? So we'll use the first low-hanging fruit approach here. So the fair value gap there, imbalance, sell side only. The market's going to want to revisit that area. This is exactly what I teach you. This is exactly what happened. Look at the bodies of the candles. Yes, there's a little bit of movement just above this candle's low. But look at the bulk of these candles, the bodies. They're staying within that range that's defined by what I teach you as a fair value gap in a premium market. What makes it a premium? It's above the 50% level. So it's gone up into that level here and it's consolidating. On the 15-minute time frame, pause the video, look for what you can identify based on your understanding and experience learning under me so far. Okay, if you need more time, pause the video. All right, so here's midnight, New York local time. We had a fair value gap here, bullish order block, these last 3 down closed candles. That's one consecutive order block. It digs into the order block with the fair value gap, hits that during the London session. It rallies up. We create a fair value gap here. It runs buy side here, and then creates relative equal highs ahead of the New York session. So the market drops down, goes into the fair value gap here, into the last down closed candle, bullish order block there. That's where you could be a buyer ahead of the 9:30 opening. Why would you feel confident to do that? Because we already have an energetic price run from London Open. The market started at midnight and went where? Did it go up? No. It went down into an imbalance, and then there was a lot of energy off of that. So the market created a short-term shift in market structure here that's bullish. London creates the high or the low most of the time. 70% of the time, you're going to find that that is true if your directional bias is correct. So I'm trusting that that low is probably pricing in the daily low. This retracement into the New York session, we're trading into an order block we close up this fair value gap, then we rally a little bit and drop back down into the fair value gap once more, creating optimal trade entry. That's not what we're going to focus on this one here. But we have the New York AM session beginning here from 8:30 in the morning to 11. This is specific to index futures for the morning session. This is the upper level on that fair value gap on the hourly chart, and this is the lower level on the hourly fair value gap. So that's your targets. It's going to be draw on liquidity.